Palantir and Tesla stock are two of the best performing stocks in the market this year. The companies are rallying on the back of investor enthusiasm for their performance. But which one is the better stock to buy right now for long-term investors? That's the question I'm going to answer in this video by comparing these two innovative growth stocks across critical financial categories, including revenue growth, return on investor capital, and operating cash flow to sales ratios. I'll also look at valuation. I'll share with you my proprietary discounted cash flow models for Palantir and Tesla, and we'll look at valuation on a forward price to earnings basis before I come to the conclusion and answer which one of these two innovative companies I'd rather buy at current market prices.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starting with revenue growth from 2018 to 2025. Now, Tesla did a remarkable job growing revenue in its earlier days of developing the newer models, growing revenue from $21.5 billion all the way up to $96.8 billion. But since then, revenue has actually declined from $96.8 billion to $95.7 billion. And given the reports coming out, in fact, yesterday, I did a video about Tesla reporting on how the sales of its cars in Europe are down 50% year over year in April. And then from January to April, sales in Europe of its cars are down over 40%. Automotive revenues are still roughly 80% of the company's revenue. And so declines in that segment will hurt the company's top line revenue. Palantir, meanwhile, is actually accelerating revenue growth, whereas Tesla is going backwards. Palantir's revenue totaled $3.1 billion in the trailing 12-month period, up from $600 million in 2018. In recent quarters, Palantir's revenue growth has accelerated as its new AIP product is gaining traction among enterprise as well as government customers. The company expects revenue growth will accelerate for the rest of this year and perhaps even longer. Looking back, the compound annual revenue growth rate for Palantir at 30.3% has been better than Tesla at 27%. So longer term, Palantir delivering better revenue growth than Tesla, and definitely shorter term, Palantir's revenue growth prospects over the next 3 years look much better than Tesla's prospects over the next 3 years. Now, beyond 3 years, if we're looking at 3 years and after, it'll largely depend on if Tesla can develop driverless car technology in the way it's been promising investors. If it does, then that can be a huge catalyst for Tesla to increase revenue. Or if Tesla actually develops that lower priced model they've been promising investors for several years, that can also be another catalyst that can drive revenue growth. Without those new products, Tesla's revenue is likely to move backwards for 2025 and 2026. The next metric I wanted to compare these two on is returns on investor capital. Palantir has done an excellent job growing its ROIC from negative 130% in 2020 up to 39.8% in the most recent trailing 12-month period. Tesla, meanwhile, again moving backward in this metric after reaching highest levels of 27.7% in 2022, all the way down to 7.6% in the most recent trailing 12-month period. And given the factors I mentioned in the previous slide, the company's revenue is declining. And given that it's a vertically integrated business, meaning it does everything in-house, it doesn't outsource very much of its activity. And so when its revenue is declining, its costs are remaining the same. And so that's creating a bigger headwind on profitability. In the most recent quarter, its operating profit margin fell all the way down to 2%. I wouldn't be surprised if that operating profit margin approaches 0% over the next quarter if its revenue continues declining. Now, this level of 27.8% ROIC for Tesla was a one-off situation that I don't expect to repeat. The company benefited during the pandemic because other auto manufacturers slashed production. they had a hard time getting the materials they needed to produce their lower priced models. So they only focused on producing their highest priced models, and car supply was extremely constrained. And Tesla was able to maintain, for the most part, its manufacturing capacity during that time. And so it produced at its usual levels, while most other automakers produced at roughly half of their usual levels. So Tesla generated sales from customers that were unable to find other cars to buy. But now that production has increased and the auto industry is back at producing at normal levels, Tesla's losing significant market share worldwide in every category, in every part of the world you can imagine. Before I talk about the operating cash flow to sales, let me share with you, I'm getting this data from finchat.io. That's where I'm getting these charts from. There's a link in the description for their services. So operating cash flow to sales ratio gives us more of the same, in that Palantir is doing an excellent job increasing this number all the way up to 42.8%, much better than Tesla at 17.6%. But the good news here for Tesla stock investors is that this metric has been improving over the longer period. If you look back at 2018, Tesla was generating OCF to sales ratio of just 9.8%. It's now all the way up to 17.6%. The thing that's working in Tesla's favor in this regard is the company's growing segments, including the energy segment and the services segment, which do not require large outflows in capital, because with every new car buyer, Tesla has to spend thousands of dollars to build that car. Also, Tesla's direct-to-consumer model allows it to control inventory better because it's connecting to consumers directly and it's taking orders, and sometimes it's not producing those cars until it gets an order from the customer, and therefore it can moderate production to the level of consumer demand more closely than perhaps most other automakers can, because of their dealership model, where there's a middleman between the automaker and the end consumer. Longer term, if a larger percentage of Tesla's revenue is coming from driverless cars and driverless rides, that could also put upward pressure and increase its operating cash flow to sales ratio. But that's many years in the future, and it's still uncertain how that product will turn out, right? It's scheduled to start testing in June, and there's a long runway between testing and actually delivering a product to the market that's generating revenue. So don't expect anything from this category in terms of actual revenue in 2025. Probably nothing in this category in 2026 either. Maybe by the end of 2027, they can start generating some revenue from these driverless cars on a very small scale. And then maybe in 2028, you'll start to see some leverage in this category that starts to contribute to the company's revenue and profitability in any meaningful way. So several years in the future, if at all, and very risky in terms of the potential outcomes of that product line. So Palantir, well ahead of Tesla in this category and nearly every category we evaluated. So looking at my proprietary discounted cash flow model, I calculated an intrinsic value of Tesla stock at $88 a share. The current market price is $359 a share. So I'd like to point out that I'm forecasting robust increases in Tesla's free cash flow. I'm forecasting that Tesla's free cash flow will rise from $5.26 billion in 2025 all the way up to $93 billion in 2035. So I am by no means suggesting that Tesla will not grow exponentially. I'm forecasting an almost 20x increase in Tesla's free cash flow between today and 2035. So I'm forecasting huge increases in free cash flow. But even after accounting for that, the intrinsic value per share I calculate is $88. That just demonstrates the magnitude of the optimism from stock market investors on Tesla stock. So I'm forecasting a 20x increase in free cash flow. Imagine what other investors are forecasting for Tesla in order to achieve anything near a valuation that shows Tesla stock is undervalued. For Palantir, I calculated an intrinsic value per share at $28.51. The current market price is $124. And similarly, I'm forecasting robust free cash flow increases for Palantir. I'm forecasting a free cash flow of 1.5 billion in 2025, rising all the way to 20 billion by 2034. So again, a roughly 20x increase I'm forecasting in free cash flow, and still the stock looks overvalued in that measurement. Now, when I look at valuation on a forward price to earnings basis, Palantir is trading at a forward PE of 199, while Tesla is trading at a forward PE of 169. So these are very expensive companies. They do have great prospects for the future, but the trouble for an investor is that most of those prospects are already priced into the valuation. It's no secret that they have excellent prospects. In fact, most stock market investors are overestimating those prospects for these companies in the future. But at least Palantir demonstrates a very strong performance metrics in those very important categories, including the return on investor capital, operating cash flow, and revenue growth, while Tesla not really demonstrating strong performance in those categories. So if I had to pick between these two right now, I would pick Palantir as the better stock to buy.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.